Hey guys, in this video, we're going to go over the difference between in the money and out of the money calls. Now, we kind of glazed over this in our previous options Greek series and our options basic series, what to know before we place an options trade. So we glazed over this multiple times, but I guess we never really went in and kind of just dug through the pros and cons of purchasing something in the money or purchasing something out of the money. We have some questions coming in. Basically, you have your assumption right. You looked at the charts, you got the chart sent to you, whatever, you know exactly what you want to do, and you're trying to work out this mechanical strategy, but you just don't know what to purchase. Okay. And you don't really understand how it all works and why I want to purchase where I want to purchase. Okay. So that's what we want to do. We want to teach you guys how to do this on your own, be very mechanical, not emotional, not basing things off of what other people have been trying to tell you, but to make assumptions or make decisions on your own from your own assumptions. Okay. So if let's just say, for example, you went through your chart, you went through all your assumptions, you know for a fact that you want to purchase a call in Apple. Okay. So that's based on volatility, technical analysis, fundamental analysis, whatever. You want to purchase a call in Apple. All right. And you decided you're going to go out to October 15th. All right. So you know that you want time kind of in your favor. You don't want to get burnt here in the quick, in the weeklies, or in the September monthlies. You want to go far out, give yourself some time. So you already checked off all of those. All right. So you get into your October monthlies here in Apple, and then you look at this options chain, you go, I don't know what to buy. What would be the best for me? Because people in here, or not in here, but people out there, they live and die by either, well, you have to purchase something in the money. If it's under a 70 delta, then don't even purchase it. And then some people were like, well, if it's a 50, you stay there. And then they say, well, no, just stick at that 30 delta all the time and then just manage properly. And it's like, well, what do I do? And honestly, it comes down to whatever fits for your own risk profile. All right. Because you made all the assumptions on your own. So why are you letting people dictate your actual call option that, or your actual contract that you are purchasing? Why are you letting them make that decision for you if you just went through all the steps on your own to create your own assumption for that first call and to begin with? You know what I'm saying? So that's what we want to do. We want to teach you guys kind of do this, how to do this on your own. It's kind of the pros and cons. So let's just say you go in here, you look at your calls, you go, okay, what do I want to buy? Well, we're going to look at these 130s first. Okay. So what's the pros and cons here of me purchasing this? Well, your delta is going to be really high. Well, that's great. We have like a 90 delta. Okay. Awesome. So each dollar move the stock makes, Apple, I make 93 cents on this $2,500 call that I just purchased. Nice. What's a downside? Well, I just purchased a call for $2,500. Maybe I didn't have $25 laying around. Maybe my account's only $3,000. And that's more than what I like to allocate in here for this Apple call. Also, our Vega is low. We know that our Vega is all at the money. As you can see here, look at this nice little bell curve that we make. So low Vega. So that's good. We're not really affected by the volatility crush that we'll get. Well, what if we get an expansion? Well, we're not going to be able to participate in that expansion of our calls because our Vega is relatively low compared to at these monies. What about Theta? Well, Theta, we don't really have to worry about that because we have more delta stability the deeper we go in, and our theta gets less and less. So that's always good as well. So all in all, it's really up to you and your risk profile, but also the biggest thing I would say is when you're looking at call contracts or just contracts in general at the 90 delta, your volume is going to be ridiculously low compared to everything else. And then I'm just going to open up that volume here for you. So you can see down here, you only have 79 volume, whereas you're in the thousands up here. So you can trade these in and out all day. You're not going to get stuck with anything. These are trading like water. And what if you did want to put like 25 grand down? I want to purchase 100 of these. Well, guess what? You're going to get ripped off because there's only 79 volume. Look at our spread. It's over 30 cents. So you're going to get ripped off in here, and then you're going to have a hard time trying to sell these. Okay. So that is a downside to those in the money. If we go here to the at the money options, what is our pros and cons here? Well, our delta is going to be lower. It's only 65, but we're still in the money. So that's good. But each dollar move the stock makes, we're only going to be going up right around 65 cents. We have more volume here. So our bid ask is going to be a little bit tighter. So that's always good. It is going to be cheaper though, as well. So our break even, since we are at the money, our break even is going to be up here and actually out of the money. So even though we're purchasing purchasing something in the money, our break even is always going to be out of the money, because we have to add what we're purchasing this contract for onto the price of the stock or onto the strike price. And then that's where our break even ends up being, right? So our break even is actually out of the money. Our Vega is going to be the highest in here. Our Gamma is going to be the highest in here. And then our Theta as well is going to be quite high, because everything here at the money has the highest chance, has the highest probabilities of being in or out of the money faster than any other option. That sounds really stupid when I said that out loud, but it is true though. So the 150s and the 155, since the stock's currently trading at 154, those are the next two options that have the highest chance of becoming in the money or out of the money, right? So you have to go through 150 before you get to 154. You have to go through 155 before you get to 165, 170, etc. So it sounds really stupid, but that is the reason that all your volatility is here, is because all these here at the money have the highest chance of becoming in or out of the money. So that's where all your Vega is. That's where you're going to be affected by that IV crush, that IV expansion the most. Your Gamma as well. So your Gamma is going to be high in here. I'm just going to go ahead and open up Gamma for you guys. You can see here, it's at 3 compared to 1, which was way up here in the money. So your rate of change of your delta is going to change drastically, especially the closer we get to expiration. Your Gamma is going to shoot up, and that's going to affect it as well. And I guess last but not least, if we go into our Theta here, you can see that our Theta at the money is going to be the highest as well, because guess what? That's where all your volatility is. So therefore your highest time decay is coming in there as well, because you have less delta stability in here, right? So your delta is pretty stable up here at the 90s, but then if you go out here where it's 0, well, it's all extrinsic value, and there's really not a whole lot out there to suck out in time decay. So all your time decay is sitting right around these at the monies as well. So let's just go to, let's say we're going to purchase something at 30 delta or higher. And usually that's where you see people coming in, and that's when they're playing these lottos. That's when we're playing day trades or scalps. And the reason that people do this is because it's low risk, high reward. Okay. So most of these, if we're playing these 165 calls here, we're in relatively low IV rank of 12. Our raw IV is only 27%. You got a $7 expected move on a 154 stock. And we're going to grab some of these 165s. And we're only $10 basically away from this expected move. Or I'm sorry, we are $10 away from where the stock price is trading, and we still have a $7 expected move. So we're about $3 outside that expected move, but it's only going to cost us $138 here. Okay. So that's why people like to play these. Obviously your delta is going to be low. So each dollar move here in Apple, we're only going to make 20 cents on this contract. But you also have, you still have some IV in here. So you can still get a nice expansion. Your Gamma is still relatively, it's not completely low, but there still is some Gamma in there to where that rate of change of your delta might change quickly in your favor, especially if you get a nice big move right to the upside. But a lot of people play these out here just to take a quick, you know what I mean, 10, 12, 15, 25 cents off of this contract, and then boom, they're out. You know what I mean? So you come in here and they'll grab, okay, well, these are only 100. Well, I can just buy 10 of these rather than buying one at the 145s. I can buy 10 here, watch it go up about $1, boom, and get out. I'm done. Don't have to worry about anything, right? Or I can get in here. Oh, it's only going to move up around 30 cents. That's fine. Well, 30 cents times 10, that's $300 on the day. I will take that any time of the day, right? And then that's most of the time where all your volume is as well. So you can see ever since we got here out of the money, you can see all the volume is in these way out of the money call contracts. So let me look, it's a 5 delta call here in October, and you have 3,000 volume in here. So it's going to be all about the volume is where you're going to look at first. Second, it's going to be what is your risk profile? What can I afford? And how many contracts do I want? And then you also have to take into consideration, you got to look at your Vega. Where is that bell curve starting and how is that going to affect me? Where's the volatility rank? Where is the raw IV? And then you're going to go in here and you'll look at your Gamma as well. Where's my rate of change in my deltas? How's that going to affect me? And then obviously at the end, you have to look at Theta as well. How much, since I'm purchasing, my Theta is going to be negative. So how much am I going to lose each day that I have to hold this contract? And if you can manage your risk accordingly to your own account size. Just kind of running through these, that 90, that 65, 50, and then that 30 or below deltas, and just kind of do a little, just kind of take inventory on your account, take inventory of the call contracts that are trading in here, and find out what fits best for you. And also, before you just go in here, well, I'm going to purchase this and just hold. Well, no, you have to have a game plan. Where am I holding this to? Where's my TA telling me that this stock is going to run to? What if the trend breaks? How will I manage this? Am I going to sell at 20%? Am I going to sell at 30%, 50%? Am I going to try to hold as long as I can and make 100% profits, right? Or what if this trade goes against me? What if we break the uptrend and we start going down again? Am I going to cut at 30? Am I going to cut at 50? Am I going to average down? What would be the best for your account, right? So that's why a lot of people play these out of the money options, because it is that low risk, high reward. Because if you buy these 165s at 138 and the stock starts trading against you, well, you're only out $100. And guess what? I can double down if I want to, right? So say Apple drops to 140 and I'm in the 165s. Well, I can really hold these for a lotto if I want to, because they're going to be basically worthless anyway. Or I can just kind of double down on the 165s and average down, or I can kind of ladder my positions in here. I can come in with the 150s, the 155s, and then I can start looking at different expiration cycles as well. And then I can take in here this October, and I can start selling things against that 165 because we're so far out. So it's all up to you and your risk profile, how you want to go about this. But that's sort of a crash course in here, the difference between those in the money and out of the money options. You have to kind of take inventory on your Greeks, on your volatility of each, on your volume, on your cost, how's this going to hurt you, and then see what fits best for you, and then play that accordingly, and then manage, be mechanical as you possibly can. Always manage profits when you can. It's all up to you, and trying to find out the strategy that works for you, right? So we can preach all day long that yes, 30% profits works, 50% profit works, but it's all up to you. If you're down with just taking 15% profits off the top every single time and it's working for you, go right ahead and do that. We are not knocking that at all. So again, that was kind of just a short little crash course in here on the difference between in the money and out of the money options. If you have any more questions, feel free to reach out to us. We will try to answer all of them to the best of our abilities. Okay, guys, thanks for watching. Make sure to check us out on our social media. We have attached links to our socials in the description, and we also have a trading service if you're interested. There's more information in the description below.